subsequently. We really hope that you're going to pick something of interest out of this conversation, because it is of interest. I'm really glad that today we're joined by Ken Kishinga, who's the chief economist at Mentorio Economics. Ken is a friend, and above all, is someone I really respect in terms of what he's been able to do in the last couple of years. If you Google Ken, I think 10 years ago, you'll not find his name. But now he's sharing the table with serious economists across the world, discussing economic aspects. Of course, if you'd like to, after this session, if you'd like to get his contacts, I'll make sure that Ken shares his contacts. And he's the man of the moment, because anyone in Kenya is wondering about what's happening with the economy, what's happening with the exchange rate, what they can be able to do, what they should not be doing, what they should be doing, what should they expect in the next couple of years. And I know he has a number of speaking engagements on the same topic over and over and over. But Ken, I don't want to speak anymore. Maybe you can just first introduce yourself, so that people can just know who we are talking to. And then after that, you can jump onto the topic for the day.
Many thanks, Stephen, and many thanks, Lian, and good morning, everyone. Indeed, this is a wonderful day, the last day of February, and I'm really glad to be here again for the second time. Really honored to be part of the team and to see my friends and also my friends within the group. And I really look forward to a good session. As you've been told, my name is Ken Kishinga. I'm the chief economist at Mentorio Economics. Our work really is to advise clients on the state of the economy, advise clients on focus, where do we see various macroeconomic indicators, inflation, GDP, exchange rate, and really to also give an independent perspective. Many investors come to Kenya, they talk to governments, they talk to donor-funded entities, but every now and then, they always want an independent perspective, somebody who can give them the unvarnished truth about really the state of the economy. So that independence is a great asset to us, and I really hope we utilize it to the best of our ability. Harvard University, focused on Joseph Schumpeter, really the man who coined the word entrepreneurship. And really, I'm very passionate about businesses, about entrepreneurship, private sector. I believe these are the engines of growth. And really, I constantly appeal to government to create a good business environment for businesses to thrive so that we can create a wealthy, stable, and prosperous country. Many thanks.
Okay, thanks, Ken, for that kind introduction. So I don't know, we could start this conversation from anywhere, because there's so much to cover within 1 hour. And we always love when you join us, because you do share the independent view. And I like the fact that you really underline independent, because people want to know exactly what's happening. There's lots of stuff you see in the media every other day. You're not so sure whether you should trust all of that. So it's really good to have someone who understands this topic and can share a couple of ideas. So let's start just from the macro. Simple. What's the state of the economy? The Kenyan economy, if it was a company, how would you rate its performance at the moment? And where are we going? Maybe let's start from that broader view, and then we'll sort of come down to different facets.
It's interesting you use the word company, Stephen, when you talk about shareholders. But indeed, the Kenyan economy has a number of good things that many investors come to do to invest in Kenya. I think if you look at the three main reasons people get attracted to invest in Kenya, really look at the demographics. Our median age is 19 years. A very young economy, people who want to graduate, get jobs, buy houses, buy cars. So many brands get attracted to that. If you compare our median age with the median age of countries like Japan, is about 46. Germany is about early 40s. Even the United States in the late 30s. People see the future really of young people in Africa and in Kenya. Number two is we have a very diversified economy. We are not really reliant on any one sector of the economy. Obviously, agriculture is our backbone, but we have a number of sectors that one can invest in. If you compare that with other countries across Africa, many of them are commodity dependent, depend on gold or oil or silver. And really, if those commodities prices go down, almost the whole country goes down. Those countries suffer for what is called the Dutch disease. Really, this is a phenomenon where a country is so dependent on oil, for example, that it forgets to invest in other sectors. In Kenya, we don't have that. You have tourism, you have agriculture. Really, if one sector goes down, another sector can thrive. And really, that makes it a bit more resilient. And thirdly, I'd say we have a good infrastructure, whether it's your expressways or your bypasses. There was a time you could not move around Nairobi without seeing construction on the road. So we have heavy investment in not just physical infrastructure, but also digital infrastructure. Things like M-Pesa. Many countries across Africa still don't have mobile money implementation. So those are the things that make Kenya very, very attractive. Unfortunately, there are many challenges to this economy. Our taxation rate, we'll talk about that, seems to be getting very, very high for businesses to thrive. Interest rates are very high. One commercial bank today is quoting loans at 27%. Very, very difficult. Non-performing loans in the banking sector, about 15%. And government regulation is becoming very, very tight in terms of whether you have to invoices really have to be processed through the government. So it's becoming a challenging environment. So you have heavy taxation, high interest rates, a regulatory environment that is very tough. So these are the things that are now complicating the business environment. And that's why now you're starting to see some brands getting quite uncomfortable, some of them even divesting. So it's something that I think I would give Kenya a 5 right now, just a 5 there. Country with a lot of possibilities, but unfortunately, we are not harnessing all the factors of production to really make us into almost like a small superpower.
Thanks, Ken. Just for clarity, is it a 5 out of 5 or 5 out of 10?
That's a 5 out of 10. That's
5
a
out of 10.
50%, right? I mean,
That's
we're in a
excellent
country
math.
where security, in a continent where security is a problem. So the fact that we have peace, we have law and order, still we have to thank the government for that, because still many parts of Africa are war torn. So we give credit to them. And as much as the business environment is conducive, unfortunately, that's not the case. So I'd give it a 5 out of 10 for now.
Okay. So lots of potential, but there's some stuff that you've gotten right. So maybe for someone who doesn't, there's people who are dialing in from outside the country. They probably don't understand why we are speaking about the things we are speaking about things. How did we get here? We started, and if you sort of like roll the clock back to 2002, when the Kibaki was sort of like coming on board, the second last president, and sort of like everything was so optimistic and so forth. The economy was doing really well. How did we get to this point where we are sort of like saying tax has become a big issue, interest rates have become a big issue? Is it self-inflicted wounds, or is it something from outside which is affecting us? Maybe you can just walk us through that.
Definitely, that's a very powerful question. And first of all, let me start by saying that Kenya's cycles operate in what I call 30-year cycles. 30-year cycles. So even if you go back to really the foundations of the country, really, even in the colonial period, where you have the 1890s, there were British coming in, setting up the railway from Mombasa all the way up into the country. It took about 30 years from then on, in the 1920s, before Africans started agitating for land, agitating for rights. These are the days of the Harry Sukun and such. And that generation, it took them another 30 years before they gained success in the 1960s. So this is the founding fathers, the Jomo Kenyattas, the Jaramogi, Oginga Odingas. And for them, it was about political ownership of the country. Really, we want to have Africans in government. We want to have Africans in high leadership positions. And that was fine because Kenya was a small country then. So, and we didn't have that many schools. Even the number of graduates coming from the schools were very, very little, and they could all be absorbed in government. In fact, if you talk to people in their 70s and their 80s, people went to university, that tell you by the time they were graduating from university, they were being just plucked out of the universities and they would get jobs. There was no such thing as tarmacking in those days. You are quickly absorbed. But the challenge, though, was the population was greatly increasing. The population was vastly increasing. And when we got to the 1980s, we had that session paper number 1, really that talked about it's time to create the private sector. It's time now, the real growth, you can only hire so many people in government. The private sector is the one that can sort of try and open up that space for more and more people to find abundance. Government, things like the Kenya Post and Telecommunications were broken down or creating path for the likes of Safaricom to start coming up. So the private sector started coming up. And when Kibaki, who had been an economist long in government, came in, he knew that the private sector is what will be the engine for growth. So one of the key things Kibaki did was he made sure interest rates were very, very low. At that time, treasury bills were at about 1%, 2%, 3%. So banks really could not make money from government security, and we really had to lend money to the private sector. That's why when you talk to anybody who did business with those Kibaki years, they tell you getting a loan was the easiest thing. All you had to do was show a payslip and you'd be given a loan, because banks could not make money because of very low interest rates on government securities. However, after Kibaki's term, we went back into the great borrowing in the previous administration, under the Uhuru administration, where we saw really the country borrowing. One could say, yes, it was for infrastructure, which is useful, but that borrowing was quite excessive, and it started crowding out the private sector. We saw interest rates going up, and ever since, really, interest rates, even into this administration. Only 2 weeks ago, we had the infrastructure bond, which was going for 18.5%. You know, why would anyone want to invest in any other part of the economy when you have an infrastructure bond of 18.5%? In fact, we had a client from Egypt who wanted to put up apartments, and we created for them a financial model, and they were showing returns of 11%. And the client was, why would I want to put up an apartment with all the risk of having being an apartment owner with 11% return when your government is giving me 18.5% return risk? So we crowded out the private sector, and that's the problem we have today. We have a very crowded out private sector. Government is quite bloated, and with high interest rates, it's very difficult. As I said, one commercial bank is loaning at 27%. It's very difficult to run any business with loans at 27%. So we are seeing the private sector under great pressure, and that's why we are today. And unfortunately, that's the key employer in Kenya, the private sector. So when that sector doesn't do well, you have high unemployment. Last year, we lost about 70,000 jobs, according to the Federation of Kenyan Employers. I think it's even more. And obviously coming from a post-COVID effect of people losing jobs. So it's a tough time for the private sector, and I think it's time for the private sector really comes together through the lobbies and advance for greater environment for private sector.
Wow, thanks for that history class, because I think it really lays the context for our conversation. And you know, there's so many tangents I could take from here, but let me just take this one first. So it sounds like the problem has been coming for quite a bit of time. And I think one thing I've learned over a period of time is that the problems that you create over a long period of time, you cannot solve in a short amount of time. So let me just start maybe, and this was going to be among my last questions. You know, what's the path, you know, for moving from where we are to you know, T-bill rates of 1 to 2%? Is there any path? And you know, how much pain shall we take? And I guess that leads us naturally to the conversation of the pain we're taking, and whether that pain is justified, you know, from the perspective of, you know, tax, specifically, because I think tax is a bigger one. You know, what's the path to get out of here, and what pain must we take to move out of here?
Well, I think first is to recognize the problem. And I don't think we've ever recognized the problem very clearly. And back a few months ago, when the president was in Nakuru, speaking to a group of Jubilee MPs, he clearly defined the problem as debt is a significant chunk. He said out of every 10 shillings we collect, 7 shillings is going to pay debt. So we're only remaining with 3 shillings to go to counties, to pay salaries, and find whatever meaningful development. That was a very powerful statement because it was the first time really a Kenyan president has defined the problem that debt it's killing us. We can't have quality hospitals, we can't have quality schools because we are servicing too much debt. So because we've never really find, in the previous administration, I remember President Uhuru would say, Japan has debt of 200% debt to GDP, and the US has debt of 100% debt to GDP. So why are we complaining that our debt of 70% debt to GDP is a problem? But the problem with that argument was those countries borrow in their own currency. So Japan, you borrow in yen, the US, you borrow in dollars. So in the worst case scenario, they can print their way out of that debt. But for us, Kenya, 55% of our debt is dollar denominated or foreign exchange denominated. So every change in exchange rate, just one slide by 1 shilling, our public debt goes up about 40 billion shillings. So the fact I think that the president now has defined that debt is a problem, I think that's the first step. Now the next step is what do you do about it? And I think it's always about creating a taxation system that works because now with this administration, they're making another mistake. Again, they are comparing with Japan, like comparing a lot with Japan. And 2 weeks ago, the president was in Japan and he said taxation in Japan is 35% to revenue to GDP. In Kenya, it's only 15%. So why are we complaining as Kenyans? Yet Japan is collecting much more, but they forget it's about the structure of collecting those taxes. In Japan, VAT is less than 10%. In Kenya, VAT is 16%. In fact, there are proposals to lift it to 18%. So we have heavy on consumption taxes, which is the wrong way because consumption taxes kill demand. Consumption is what drives the economy. So when you add VAT to everything in the economy, like right now, one of the proposals is to add VAT on educational services. Yet human capital is our competitive advantage. So we have to be very careful in terms of consumption taxes. We need to move more towards progressive taxes, really asking ourselves, what are the factors of production? Are the people who have the means of the factors of production, are they being incentivized to invest? And we have to look at those types of taxes. And that's a shift. On the revenue side, again, as I said, we have a very bloated government. And okay, right now it's making some attempts towards privatization. The idea then is to try and offload some of these functions to counties, to private sector, to reduce that. But you have to look at the revenue side, you have to look at the expenditure side, then you can solve the debt part. Back years in the year 2005, they actually passed a budget with zero borrowing. It is very, very possible to reduce that borrowing, to reduce that debt, and to start crowding in the private sector.
Wow, thanks for that. And I like the point that you just brought up about comparison with the likes of Japan, because I think the other factor that we don't look at is the extent of formalization of those economies, where really then you're not taxing. Because if we look at our economy, the number of people who, for instance, are contributing corporate income tax, the employed people, they're very few, and we've left out a huge chunk of the economy that probably are not paying taxes based on how much they're generating on a day-to-day basis. But then that also brings up another issue, right? And maybe this is a question to you, and maybe let's focus on tax for just a second. So we want to widen the tax base, and there's a couple of measures which have been put. And I know the argument that's put out by the government about things like VAT is you're trying to capture as much as you can, right? Because there's some people who are not in these tax brackets that can be able to tax with corporate income taxpayers you earn and so forth. So you look for other forms of taxation. What for you would be the solution in terms of widening this tax base? Because you need to collect more to be able to solve the problem we've just spoken about. Yeah. But then on the other side, you also don't want to overburden the economy from that perspective. Yeah. Just to take this point forward, because if this was a company and someone told me, you have a lot of debt, so how do you solve the issues you have? I would say, of course, number one, renegotiate your debt. Yeah. Maybe if you're supposed to pay it in 10 years, make it 30 years. If it was in this currency, maybe reprice it to local currency. That would be one thing. Number two, I would tell them, generate more income. Number three, I'll tell them, cut your costs, right? So not very different from what you'd handle from a company perspective. But now on these, generate more income, because I think that's at the core of these. And maybe just take that illustration and maybe share with us some ideas in terms of how do we move out of these problems that we have.
Well, I've said several times that we need to look at the property market, the land market. Land is a factor of production, the chief factor of production. But if you look at the rates that we pay in Kenya, it's extremely low by regional standards, by global standards. Right now, I'm sitting here in Westlands. 1 acre in Westlands here, maybe it's about 300 million, 400 million shillings. But the annual land rate that you'd have to pay for this property here is probably 0.00001, extremely low. The last time we did a proper land valuation in Nairobi was 1980. So the land rates we are using as values are highly out of date, and the government is losing legitimate revenue that it can be using for development. If you go to many cities, whether it's South Africa, whether you're in Santon, whether in New York, whether in Tokyo, property rates are normally at around 1%, 2%, and 3%. And that is the money that goes to schools, that goes to hospitals. In fact, in America, your children would not go to a school outside your school district where you live and where you pay your property rate. So it's an area where is really exempted the landowners. Really, people are paying nothing. And what it does is it fuels speculation. So this whole phenomenon of people having idle land, it's a very Kenyan phenomenon where you buy and you sit on it, it's idle. In places where you're paying market property rates, you have to put it into production, because at the very least, there's a bill that will be facing you every year. And at least you have to put a bit of investment into it, at least if only to pay that bill. So I think it's the one area that has been highly exempted. And without doing that, it means now governments now have to burden ordinary mwananchi or mama mbogas with extremely heavy taxation. And consumption taxes are regressive because they hit the people at the bottom the most. When you add VAT on bread, on milk, actually people start substituting. People find cheaper substitutes. If you put it on wine, people start looking for illegal liquor to be able to get by. So it's very important we ask ourselves, the producers, the people who can't have the capacity to produce, are they being incentivized? And in Kenya, absolutely not. And that's why you can have idle land. Yeah, many people here, that's their Saturday hobby. You just go and buy idle land, have namatoma. I think you never see that in any part of the world. So you have huge productive land that's idle. Number two, our capital system. Banks still, again, are lending so much to government. They're buying T-bills, buying bonds. They're not lending to business. The credit sector to the private sector is quite low. It's about getting the people who have the function of production, incentivizing them to produce. Once they start producing, once a landowner says, wow, I can't have 1 acre in Westlands as being idle because 1% of 300 million, that's 3 million shillings. I need to put up a hotel to make some money. The moment you start thinking that way, then now you start creating jobs. So you have all these people from the informal, you start hiring people, and people now start paying income tax from the incomes, and you start formalizing the system. But you have to look at that part of the factors of production and resolve that. And unless you do that, we'll end up just hurting consumers. And when the consumption is hurt, even producers will not come. Producers only build things because there's a market. If they don't find there's a market or things are too expensive, they'll exit. So those for me that is the number one area that we have to retilt, reduce on VAT, but we need to increase a bit on the property market to be able to rebalance the economy.
As you're speaking, Ken, I was thinking about the idle land that I have. And I was thinking that if this comes into place, I need to start selling some of that because you are right. It's a hobby for Kenyans. You don't even know where the piece of land is. You just sort of like just take on it and say, let me just buy some and just wait for a rainy day. Okay. Thanks for that. I want to switch gears a bit here. Because I mean, we could spend a lot of time on this topic, and I would want to spend a bit more time, and maybe we'll have you back at a different time. But I want to switch gears to, you spoke about the exchange rate. You said part of the big issue we have is that 55% of our debt is foreign denominated. I mean, even for a private company today, if you're not generating your income in dollars, I would be worried if I had that statistic as a CEO of the company. And you mentioned the idea that just it was a 1% move, means that our it has a 42 billion impact in terms of the total loan facility in Kenya shilling terms. So I want to just ask you, we've seen the exchange rate shift quite a bit in Kenya. Part of that, over a period of time, the Kenya shilling was quite stable at the 100, 105, sort of like a kind of rate. And then just from the year before last, we moved to 116 or thereabouts. Then last year, I think it was the year before last, and then last year sort of were stable to a certain extent. Then this year, there's just been between the second half of the year into this year, lots of carnage all the way till 160. Then we've moved down to 140, I don't know, wherever, 140, 150, that kind of range. So number one, what's causing all these shift in this case? Because part of our audience are clients, and they're operating different markets, their facilities in foreign currency, they're importing certain things, and they're just wondering, where are we going? Are we now stabilized? Why is there so much shift?
A very, very good question. And obviously, I know particularly the private equity funds really have faced a bit of exposure on that. Well, last year, obviously, global interest rates were rising because inflation was high globally. In the US, in the UK, inflation was the highest it has been in 40 years, so in 4 decades. So all central banks around the world really had to really crank up interest rates in order to bring down inflation. And when the US Fed started raising interest rates, all the dollars in emerging markets, such as and frontier markets such as Kenya, started to leave the country to go to the US because at the end of the day, investors are always chasing yield. So we saw a lot of capital flights last year, even from the stock market. You were seeing counters such as Safaricom really at an all-time low. People are just leaving. And obviously that had an impact on the currency. Now that started changing now towards the end of last year. And the events that happened 2 weeks ago really started building from November. In November here, first of all, we started seeing the central bank in December, Central Bank of Kenya, obviously noticing that the exchange rate by that point had depreciated by 20%. The shilling had depreciated by 20% in 2023, started raising interest rates. This was the first few days of Kamau Thuge, and they started stepping up interest rates. And obviously there was sort of a cry from the citizens. People are saying, interest rates are already high. Why are you making them even higher? But they needed to stabilize that exchange rate. So that was sort of the first wheel of the vehicle. Really, central bank tight monetary policy, which was again repeated in February. And in the February meeting, Thuge said something that maybe some people didn't understand. He had said the exchange rate had overshot the equilibrium. That's central bank speak. For we think that the exchange rate should be a bit stronger than it is. So that was sort of the first clue. The second clue now came from the Fed. The American economy has been doing very well. The last cycle, it created 350,000 jobs. The S&P last week hit a 5,000 mark for the first time in history, led by what is called the Magnificent Seven, the Microsoft, the Teslas, the Meta, the Google, the Alphabets, doing extremely well on the back of AI. In fact, if you look at a stock like NVIDIA stock price has gone up by 49% year to date. I'm only talking about 2 months. it has gone up significantly. So the American economy is doing well, and the Fed has already announced plans to start cutting back interest rates. In fact, there was one good interview on 60 Minutes where the Fed chairman really speaks about that. And investors start expecting, okay, Fed rates will start cutting by Q2, Q3. What that means is all the investors last year who had went back to the States now are starting to come back to emerging markets. So all those dollars that had gone chasing high yield now are looking for some Africa risk or some emerging market risk to be able to come back. And that's why you saw the Eurobonds, even before Kenya's Eurobond, the Ivory Coast Eurobond, the Benin Eurobonds, all of us subscribed. So that was really the second wheel, the Fed really signaling that move. Now the third wheel, of course, was the Eurobond, the Kenyan Eurobond. That day, 6 billion was on offer, was provided. They only took 1.5, but of course it was a significant inflows of dollars, which the CBK could use to sell a bit to the market, although it was for repurchase of the previous bond, but I'm sure some of it was used to stabilize the market because Treasury officials said there was a bit of selling in the market a bit. That was the third wheel. And the fourth wheel was the infrastructure bond in the same week that came up on that particular Tuesday afterwards. So by the time you're approaching Wednesday, Valentine's Day, that was the biggest Valentine's Day shock, I think, for a lot of people, because now all those four events now had come together. Now the vehicle was moving. The exchange rate now was moving, and it really moved. In fact, I think it went significantly below what the CBK would have expected. And they even had to start buying a bit of dollars, I think, to be able to stabilize it. So that was sort of one of the issues that really created that exchange rate movement. In terms of the way forward, obviously Kenya is a net importer. We import more than we export, and anytime you're a net importer, it means your currency is always under pressure. So we do expect to see the gentle depreciation that we've been seeing in previous years, the 5% depreciation. The CBK now has enough reserves to intervene. They say they don't have a preferred position. The work is just to make sure that there is no volatility in the market. So I think they have enough reserves. So I think we should just expect to see the gradual 5% depreciation that we've been seeing in previous year. Obviously, last year was a major outlier.
Okay, that's a good history, and I like the four wheels analogy of the different pieces which were coming together, so like to reduce the exchange rates to the current level that we are at, and of course, personally hoping that we don't go above, because I think there's some focus that we're talking to even above 200, and people have gotten really worried about that. But good to get a fundamentals view around that. Now, let me just check whether there's any questions from my audience. I don't want to make this a monologue between myself and yourself. If you have any questions, sorry.
And Stephen, as your members are giving you questions, I think I need to adjust my power source. I think my charge is a bit low. So maybe just take a couple of questions, maybe 2 minutes as I adjust my power source, just for 1 minute.
Okay, no problem. I think we can give you that for just a minute. If you have any question as we continue, kindly just type that into the chat if you feel that you want to put up your hand. But I guess it's easier. Just put this on the chat, and we'll be able to pick this up in a second once Ken is sorted on that side. So as Ken is sorting that out, I've seen one question from Mohammed about debt sustainability and distress. What's the near-term outlook, and are we out of the woods yet? I think that's a very important question. And then to touch more on what the government can do on the expenditure side to reduce the deficit. Thank you, Joe, for the question. I've picked that up. If you have any questions, please just type them in. Ken is just sorting out a bit on his power source. And then we can jump back in, but some really interesting pointers there from Ken. I think if I look at where we are at on the session, one is on the exchange rate. Ken has a view that we at a point where we can start the gradual movement where we won't have significant swings. I think we've touched on taxes and what needs to happen from a tax perspective to ensure that we're not getting overburdened. The introduction of property taxes and reduction of VAT. I thought that was a very good point, and just the why, comparison with what's happening in the rest of the world. I think what we can do around interest rates, and I think that's a good question, probably just to stick on a bit in terms of what we can be able to do. But let's give Ken just a second for him to rejoin. Ken, you okay now?
Yeah. Yes, I am. Thank you.
While you're away, while you're taking a quick break, we've gotten a couple of questions, and I want to see if we can go through them before I continue with my list of questions. So the first one is about debt sustainability. Yeah. You mentioned that, and I guess quoted from the president, out of every 10 shillings we're generating, 7 of that is going to paying debt, and 3 is what is being left for development and for expenditure. So, should we be worried about distress? I know the Eurobond was one piece of that, but then also from a local borrowing perspective, the government has really been coming to the market and borrowing quite a bit. Is that something we should worry about?
Well, you're right. We focused quite a bit on the Eurobond. I think the market, every time investors came to us, really it was about the Eurobond. Sometimes people forget that there are other commitments that the government is in, and not least the SGR loan, which has to be paid every January and June. In fact, if you look at the January numbers, I saw a story which shocked me. It said 98% of revenue was going towards servicing debt. So it tells us we are in a difficult, very tight space. And it's going to be very difficult. We might not necessarily default, but I think it's going to create a pressure on other public services. Things such as salaries, you might see salaries might be a challenge, pensions might be a challenge, healthcare, education. So I think that small window of development is being eaten up by debt service costs. So even if we avoid default in the technical term, obviously there will be side effects in terms of how much the government. For example, a good example is pending bills. The government owes almost 600 billion of pending bills to suppliers. These are contractors who worked on roads, who supplied tenders, and county governments maybe have another 200 billion. So we're talking of almost 800 billion of pending bills. And these are contractors that Kenyans, many of them who are borrowed from the banks, many of them now who are being auctioned off, many of them are being put in very difficult situations because the government has not paid them. So you start creating an disincentive for businesses to exist, because if a business is supplying government, that becomes a big exposure because you wonder whether you never get paid. So we might not default in the traditional way of maybe the Eurobond, the external debt, but I keep saying, when you're not paying your suppliers, you're defaulting in a certain way. Those are your citizens, and those are your people who are supposed to be paying taxes next year. And you'll be put in a difficult situation. So we might have a good track record in terms of the Eurobond and such, but indeed, if the business environment is not conducive, I really wonder if we'll be able to raise enough revenue even to meet those debt obligations.
Thanks for that. And I like, just listing some of the local borrowing that we have, which is a big issue, because I was just doing some back of the envelope numbers. That's almost 20 to 30% of, our total budget that's out there, right? That's not being paid to these suppliers. And if you're trying to talk about encouraging consumption, we need to be paying that so that people can, spend much more. Now, the other question, and I'll just pick them rapid fire because I think we have another 15 minutes or so, and then we have to finish, is about there's a question about expenditure in terms of, first of all, let's start with what's our deficit. And then let's move on to, how do we've spoken about the revenue side and some of the things that we could do. So let's speak about the expenditure side. And when you're talking about that, I also want to just touch on this point. David Lee, one of the other economists, mentioned something about, the cost of government, the cost of democracy, so to say. And you said part of that is just having a government, and I'm paraphrasing here, a government that's wasteful, bloated to a certain extent. And I just to get your views around, that kind of thinking, and what can we possibly do at this point, and are we doing enough?
Well, it's true what David says. There is sometimes a political economy that comes into play. If you look at the role of the CAS's positions, that was a significant expenditure that was being pushed because there were a lot of people who possibly didn't get appointed, but assisted the Kenya Kwanza administration to get into office and really needed to have their pound of flesh. And the role was created, but it becomes very bloated. The matter was gone to court. So it's true that there's sometimes a political economy that has to, if only for stability, because the government cannot operate if it has no stability. I've always said we need to apply the philosophy of subsidiarity. The philosophy of subsidiarity says that what can be done at the lower level needs not be done at the higher level. So in a company, if an intern can do a task, then the officer should not do it. If the officer can do a task, the manager should not do it. And if the manager can do a task, the CEO should not do it. So things should be done at the lowest level possible. And this is a philosophy that is very useful in many areas, not least public finance, because now you start looking at functions that governments do and ask, can some of these functions be released to counties? Can some of these functions be released to the private sector, like housing? We are in and out of court with the affordable housing program, but the constitution says that housing is a county function. Yet I never see the counties being talked about, and that program is talked about. When you talk about government owning shares in Uchumi or hotels, should governments really be involved in supermarkets? Should they be involved in hotels? These things the private sector has shown that it can do much, much better than the government. So the principle of subsidiarity, when applied to Kenya, should say Kenya government has very specific functions: law and order, justice, security. These are the things that no private sector can provide justice. No private sector can construct an expressway. No private sector can provide law and order, the military. So if the government can focus on these core functions, then it can offload many of these functions to counties of the private sector, which means its expenditure costs would be so much less. And obviously that deficit, which is almost hitting 20% of GDP, would be able to come significantly much, much lower. I think it's about applying that philosophy. Now, the challenges to that is sometimes the juice that comes from politics is having those roles that can control. So it's a constant struggle between parties. And that's what you find in the US, in the UK, you have the right and the left. And what they always differ about is the size of government. You find the Republicans are always for small government, Democrats are for big government. It becomes a philosophy, and that informs our politics. So that our future politics should be about, these are the philosophies. Do you want a more expansive government, or do you want a more private sector? And that also improves the quality of the politics, which we've not seen in Kenya. So I think that's really the way forward on expenditure, reflecting on that principle of subsidiarity, and now allowing governments to do what really they are mandated to do, and really offloading all other functions to either counties or the private sector.
Ken, thanks for that. If I was listening to this, I would also ask one question, and you've jumped that issue, which is just corruption, right? We've had so many statistics about how the numbers stack up in terms of out of every 100 shillings that we collect, how much of that goes to waste. What's your? Because I mean, there's no way, at least, and maybe you can, let us know from your own view. Even if we keep building, all these other things, and we evolve, I know at a macro level it makes sense, but if you're gonna be losing almost 30% of what you're generating. I mean, there's no business that functions like that. And I go back to my analogy of a company. If 30% of your income, you don't know where it goes, and it's a cost that is, nobody knows where this cost is, you'll never be profitable unless, I don't know, you need to be in a very different type of business.
You're absolutely spot on, Stephen. And corruption rears itself in many ways, not least in money laundering, which is one of the areas we are seeing. In fact, I think last week you must have seen that Kenya was placed on a grey list for countries that are high on the wash agenda by some financial task force. And it plays out in different ways. And actually, I had quite an interesting discussion on this particular topic on BBC Swahili service just 2 days ago. Maybe I'll share that link with you in Kiswahili for those who can understand Kiswahili. But me and my Tanzanian colleague are really reflecting on how this corruption, money laundering rears its head. And what I said in that particular link is it starts with, you have to go back into history, about the 1980s, where we had the Ndegwa Commission. Now, the Ndegwa Commission looked at the public service and said that it's okay for public servants to do business. Now, that created an avenue, a conflict of interest, where a public servant now is no longer serving the government, but is also using his office to advance private business. So you are the head of a parastatal, you are the head of a ministry, and you are receiving all these bribes because people want tenders, because people are giving you bribes day to day. And of course, you can't put that money in your bank because everybody knows your salary as a public servant. So you can't just store it in your bank. So you have to look for other avenues of sanitizing that money. Either you have a kayad or you have a club, or these are the common areas that we see in Kenya. And so you create avenues, or you have a mall somewhere. You put money of incentivizing, now money starts operating outside the formal system and it finds itself back. And that's what really feeds. And I'm surprised to see that Tanzania is the same way. You have that kind of corruption really feeding into money laundering. But the fundamental cause of that is the issue of conflict of interest, where you have public servants who are conducting private business. And you have to review that Ndegwa report. I think you have to review it. When you go to China, either you are a public servant or you're a business person. You cannot do both. In fact, you'll be short if you try to do both. They keep it very, very distinct. So I've always advocated of giving public servants very competitive wages, very competitive salaries, so that they don't need, you go to the US, people always wonder in the US, in the UK, why can't you bribe an officer in the US, in the UK? And it's because they're paid quite well and they have no incentive of pursuing corrupt tendencies. So we need to create good competitive packages for the public sector with the caveat that if one is engaging in private business, there'll be very, very serious consequences. And unless we control that conflict of interest, we will have this corruption will just keep rearing its head. And that is what is killing the private sector because people now don't invest in business. People, when they go to America, the way you become a billionaire in America is you come up with a good idea, maybe in fintech, come up with a nice idea, you create a startup, you work on it for a few years, then you list it on the New York Stock Exchange and you become a billionaire. In Kenya, I talked to many startups and very few of them have any plan of even listing. In fact, if any, they talk about delisting. Many of them are delisting for the stock exchange because it's not seen as an avenue of wealth creation. In Kenya, you want to know who is the procurement official in a very big government entity to see how now you can be able to start supplying gloves or medical equipment, and that's how you become a billionaire. So you find the government controls, money controls growth. Yet the private sector is where really growth should be. So those are the challenges, but it starts with that idea of conflict of interest, which I think we've not yet addressed. And how do you address that? In Tanzania, my colleague was telling me you have to have a wealth declaration form, but the challenge is when you enter office, but the challenge in Tanzania is when you leave office, there's no follow-up. Nobody asks you what you've made afterwards. I think in Kenya, we need to have wealth declaration forms at the beginning of your term, at the end of the term, maybe even file tax returns if you want to run for office. These are the things that will start reducing that corruption and conflict of interest?
Oof. We have to start finishing. But I like that conflict of interest conversation, and I feel like I could even take you on a different tangent of the privatization bit that you sort of like spoke about, because there's people who are for privatization that the government is doing. There's people who are against that. That's a whole conversation by itself. But two rapid fire questions, maybe one, 1 minute answers or 30-second answers. Are interest rates about to peak? One, that's from Mohammed Abdi. And then two is, should we be raising another Eurobond? Bearing in mind that the kind of carnage you've seen when the exchange rates have shifted, which leaves you very, very exposed. Especially, I mean, we do earn part of our income in dollars, but we want to retain most of our dollars internally. But should we be raising another Eurobond? What's the rationale behind that?
For interest rates, just 2 days ago, I was talking to a bonds trader, and he was saying, if you know a bonds trader close to you, keep it very close. They're about to be very happy people, because I guess they expect interest rates to start coming down. So I think the central bank, I guess it has peaked in terms of interest rates. I think I've seen the NPLs are quite high, 15%. You don't want to add, and the US is reducing interest rates. So I expect when the global interest rate starts coming down, inflation starts coming down. Obviously, we're getting inflation numbers in a couple of hours today. I think that will dictate, but I think there's an expectation that the second half of this will start seeing lower interest rates so that businesses can start doing better. So I do see an expectation something in the second half of the year, unless there's a major shock that now complicates inflation. But I do expect downward trend on interest rates as in the second half of the year. In terms of the Eurobond, yeah, we have to think about external debt. People are saying, oh, this is a sign of confidence. But when they're borrowing in dollars in double digits, that's very, very expensive. And really, that becomes a challenge. So we do need to expect that the Eurobond will start, people will start thinking about external debt, and will start thinking about how do we start moving away from high external debt. Are you can still receive me, Stephen?
Yes, we can hear you. We can hear you. We're just about to.
Oh, yeah.
Yeah.
Okay.
So I think we need to finish. We like finishing right on time. So my catch-all question, right? Which is, what's the advice for a business person, for an organization about how they should handle themselves in the next couple of, I guess for the rest of the year, in the next couple of years, 3 years, 5 years, based on everything we've discussed from a macro perspective and how that affects you all the way to the ground. It's a catch-all question. Pick any angle you want to answer it from.
I think the biggest clue comes from last week's budget policy statement. This is a brief statement that signals what you will see in the budget in a couple of months. And for me, it raised a very curious point. It said that over the next 4 years, the government has a revenue target of 6 trillion that they want to collect over the next 4 years. So already you don't even need to talk about your 1-year strategy. So you can talk about your 4-year strategy. The one thing I can guarantee you is will be aggressive revenue mobilization, because with 6 trillion is no joke. We will see heavy taxation over the next 4 years. What does that mean? It means this is going to be for a challenging business environment, not just this year, but over the next couple of years. Obviously, some sectors will do very well, other sectors will do not well, but averagely, if the government has that plan of very aggressive revenue mobilization, particularly with consumption taxes, then expect a challenging environment. Now, if the outlook is a challenging environment, obviously you have to play a defensive strategy. You need to strengthen your risk management. You need to make sure your debt levels, you're not increasing debt significantly, your debt exposure. You need to play defense rather than offense. Normally, when markets, the outlook is quite positive, you have to explore new markets, new opportunities. For this, you have to play defensive. This, for those who watch football, is when you're facing a tough team. When you face a tough team, it means you have to be very defensive. You have to strengthen your defense, your risk management. Do you have enough cash flows? Do you have exposures? Am I doing a lot of business with government? Am I doing a lot of business with counties? Some of these counties, are they getting money? So you have to have your risk management cap on. I'd say 60% of the time, think risk management. Then 40% of the time, think of opportunity. Now, carefully navigate that opportunity. The challenge that sometimes young entrepreneurs make is they operate in a field where they see uh, fruit orange trees very far off, and they want to run to that orange tree and start harvesting. The problem is there are many landmines between them and that tree, and stepping on one landmine could blow you up. So understand the map of the land, understand where are the landmines, navigate. Kenya has some very good opportunities, areas like agriculture, logistics, fintech, but still have your risk management framework, exercise prudence, and really look for that opportunity, but with a very cautious approach. Yeah.
Wow. Again, loving the comparisons here with football. I'm a football fan, and I'm an Arsenal fan, and we're playing offensive all the way. But I guess I'll leave that for the pitch, or for the Premier League, not for business. Thank you very much, Ken. That has been very, very informative, lots of learning, lots to reflect about. I really hope we can invite you again because I feel like we've just dealt with some of the issues. We've left some open. If I was asked to summarize the conversation, I would say one, there's no easy solutions. We got ourselves here over a long period. All the solutions we have are tough solutions, but there is a light at the end of the tunnel. And then probably the last thing that I would just add is, from a business perspective, you need to play the long game, right? If the opportunity is there, you can find it by taking that idea of defensive 60%, offensive 40%. Thank you very much. Once again, we appreciate you. We appreciate everything you shared with us, and we are hoping that for the people who are listening to this and those who are going to listen after this through YouTube and so forth, they're going to pick out something that will be useful for them in the coming couple of days. Ken, we'll share your contacts with everyone who's been part of the conversation, just in case they want to reach out to you. They want to dig a bit deeper in one of the things that you sort of spoke about. But super, super appreciated. Do have a lovely day. Thank you to everybody who's been able to join us today, and of course to the team that's put this together. Leanne, thank you very much for all the work in the background. Asanteni, have a lovely day. We'll end at this point.